The US president says it's only fair, but Republicans say increasing taxes on America's wealthy can only harm the economy. We ask, what does less money for the super rich mean for the rest of the country? You're watching Inside Story Americas from Washington. Hello, I'm Shihab Ratansi. Flanked by a group who call themselves the Patriotic Millionaires, US President Barack Obama once again urged a new tax on wealthy Americans. His proposal is called the Buffett Rule, after the billionaire investor Warren Buffett, who publicly complained that he pays less tax than his secretary. President Obama said it was time the richest Americans paid their, quote, fair share in taxes. The proposal would set a minimum 30% rate for those earning more than $1 million a year. The president also pointed out that one of his predecessors, the Republican icon Ronald Reagan, once called tax loopholes for the rich crazy. That, however, is something that would sit uncomfortably with today's Republicans, who vehemently oppose the plan and have even called it class warfare. Their rival plan, indeed, would cut the tax rate on the super rich from 35% to 25%. Something enthusiastically endorsed by the probable Republican nominee and private equity tycoon, Mitt Romney. Then there are those who argue that the Buffett Rule does not go far enough in restoring historical tax codes and bridge the country's ever-increasing wealth gap. Earlier I spoke to one of the millionaires backing the Buffett Rule, Professor Eric Schoenberg. I asked him to explain why he wanted to be taxed more.
There are two basic problems I would point to that the United States is facing now. The first is the government ever since the Reagan administration, with a narrow window during the Clinton administration, the government has spent substantially more than it's taken in taxes. Many people in Congress are deeply concerned about these deficits, and I share that concern. We have to do something to get revenues more in line with government expenditures. The second problem that I think is a substantial one facing the United States is the growth of inequality. Now, Americans do not really have a huge problem with inequalities in wealth as long as there are equalities of opportunities. The problem is, I think, the degree of inequality of wealth has reached a stage where the opportunity is not there for as many Americans as possible.
And that's the other argument that the opponents to the Buffett Rule and what you're advocating make, is this idea that you're getting away with something with lower rates of taxation on investment income, capital gains, is a red herring, that's already been taxed with corporate tax, and you're actually then supplementing that taxation with your capital gains tax. You're not getting away with anything. How does that argument fare?
I don't think that argument is very valid either. It is true that, really understanding where taxes fall is a very complicated one. But let's remember that I also, the bulk of my income comes from investments, dividends and capital gains on investments. But, I earn a substantial amount of money in unrealized capital gains as well. That is, I only pay capital gains when I sell an asset. So I am avoiding tax on the much larger amount of money that I'm not actually selling. It's simply going up in value over time. So, a fuller accounting of what kind of taxes people pay is a very complex proposition. But I start from a very basic principle, and I go back to what I said earlier. I pay substantially lower taxes than a hardworking middle-class American, and I don't think that's fair.
How do you think we got to a stage where that is seen as reasonable, where the taxation policies of Ronald Reagan are deemed to be akin to class warfare?
I mean, I go back to my point. I think inequality is a problem. Now, inequality has arisen not just in the United States, but many other countries over the last 30 years for a variety of reasons. My point is simply the government is making this problem worse. And if you agree that inequality is not a good thing, why should we have a tax system that actually exacerbates inequality? I've observed this happen over a 30-year period of time. It happened slowly at first and then more dramatically accelerated under President Bush in the early 2000s. Yes, it is undoubtedly due in large part to the enormous power that the wealthy have and the greater influence they have over decisions made by Congress. And that's part of my point, which is inequality I think inequality is a problem in and of itself. But Americans accept inequality as long as they believe that everybody's got a fair shot at becoming richer. When the wealthy become too powerful, they do what it takes to protect their own interests, and they make it much harder for people to gather new wealth themselves.
So are taxes fair in the United States? With me to discuss this in the studio is Alan Viard, a former economic advisor to the Bush White House. Next to him, Andrew Fieldhouse from the Economic Policy Institute. And from Denver, Colorado, political journalist David Sirota. Alan Viard, then, you heard it there directly from the 1% there. Not only would getting the rich to pay more not hinder the economy, it might actually be necessary for economic development.
Well, I don't know if I heard that precise argument being made, but I would question that because I think that if you enact something like the Buffett Rule, you're really increasing the taxation of investment. The Buffett Rule is really a somewhat convoluted way to partly undo the treatment that we currently have for capital gains, of saying that although we're officially going to have a 20% rate next year under current law, that we're actually going to take back some of the benefits of having a 20% rate and make some people pay a minimum rate of 30% on that. And I think that's an unwise policy given the way the rest of our tax system is configured. It does not reflect the fact that much of those capital gains are on corporate stock. They do reflect income that's been taxed at the corporate level already. And it also, I think, we need to realize that the Buffett Rule brings in very little revenue, $47 billion over 10 years, if you start from a point where capital gains are being taxed at 20% and dividends are facing ordinary rates. So the talk about how we're going to promote equality of opportunity, I don't really see that as being an issue here. I mean, yes, we want to promote equality of opportunity by making education and other types of resources available to those who are in need. And all of us who are better off should contribute towards that. But targeting this narrow group of millionaires...
Let's quickly just hear how President Obama described the principles behind the Buffett Rule.
I just point out that the Buffett Rule is something that will get us moving in the right direction towards fairness, towards economic growth. It'll help us close our deficit, and it's a lot more specific than anything that the other side has proposed so far. And if Republicans in Congress were truly concerned with deficits and debt, then I'm assuming they wouldn't have just proposed to spend an additional $4.6 trillion on lower tax rates, including an average tax cut of at least $150,000 for every millionaire in America.
David Sirota, though, doesn't Alan Viard have a point, though? This isn't going to help the deficit. President Obama mentioning it there. It's not going to help there. Isn't this really about election grandstanding, reminding everyone that Mitt Romney, for example, only paid 14% tax on an income of $22 million or something in 2010?
Well, I certainly think it's an election year. There's politics are always involved in this kind of thing. And I think that, yes, the political benefit to President Obama is that the Buffett Rule inherently asks questions of Mitt Romney and how Mitt Romney made his money. $50 billion over 10 years, $47 billion over 10 years. It's not going to solve the national deficit, not even close. But it's not nothing. I mean, I'm sitting out here in a state that's strapped with up to $1 billion budget deficit. $50 billion could go a long way towards solving our state's budget deficit and other states' budget deficits, as just one example. So I don't think it's nothing, but I do agree that there is a symbolism to it. And the symbolism is really, as President Obama said, fairness. Whether we want a tax system that essentially embodies and endorses unfairness. And I would say that to the question about whether it will help the economy, look, there's a lot of millionaires and billionaires out there who benefit from this tax system without the Buffett Rule in a way that the money isn't really, that their investment income isn't really going to the real economy, that they're making money, they're benefiting from a tax code through loopholes that don't really have any substantial benefit to the economy, where their money really is going into speculation, not creating real industry.
Andrew Fieldhouse, before we get on to the symbolism behind this, what about this issue that the Buffett rule in itself is a pretty ineffective move? In fact, might even lessen tax revenue as more loopholes are discovered and people fail to realize their capital gains because they're worried about taxation and so forth. These are the sort of arguments that we're hearing, as well as Mr. Viard's arguments.
I think that is totally bunk. The complaint that it only raises $47 billion of revenue over a decade is nonsense. That's assuming that all the Bush tax cuts expired. I wish that were true. We know that's not going to happen. Relative to that baseline, Paul Ryan's budget has a $10 trillion tax cut. Relative to the current policy baseline, you're looking at $162 billion, which isn't trivial either. More importantly, by establishing effective tax rates, average tax rates that actually rise with income and restoring that fundamental tenet of a progressive tax code and setting a higher revenue target, this is an important first step toward comprehensive tax reform. You want a distribution where effective tax rates rise. That's the whole point of a progressive tax code. Having that in place before we move to a comprehensive tax code.
If I can cut in, I just want to say we do already have that, though. I mean, if we look at the tax payments that are being made at different income levels.
I'm glad you said that, because I was just about to say it might be useful to take a look at some of
effective tax rates do rise. I mean, millionaires as a group are clearly paying more than the middle class as a group. I mean, the White House acknowledged that in the document they put out a few days ago about the Buffett rule.
Well, let's look at how taxes have developed over the last 50 years. The middle class has paid roughly the same percentage of their income in taxes, just under 20%. The top 1% of income earners saw their tax bills fall twice, first under President Reagan in the 80s, later with the Bush tax cuts in 2001 and 2003. But the top 1/10 of 1%, the highest incomes in the US, saw their taxes fall by half, from 51% in 1950 to 26% now. Those averages, though, mask the fact that 1 in 3 of the highest income Americans paid less than 15% in taxes, and almost 1,500 of the top earners paid no income tax at all, benefiting from tax loopholes and sophisticated accounting tricks. Alan Viard, I mean, doesn't that cry out for some change? Doesn't there seem something wrong with that, or is it just
there is
some
change, but the Buffett rule really doesn't do that. I mean, you talk about millionaires who are not paying any tax at all. That's almost certainly because they have municipal bond interest, and municipal bond interest would be unscathed by the Buffett rule.
Right. Well, again, this is just the beginning stage.
Right. Well, okay, so we can say it's the beginning stage. I really do think, though, that the whole debate about this has been misdirected. I mean, those numbers don't include the corporate income tax that is being imposed on a significant share of this income.
We're not even talking about corporate tax rates, which is actually another issue, and corporate tax loopholes.
But if we want to talk about the tax burden that's being imposed, we have to talk about all the taxes. We have to talk about the corporate tax, we have to talk about the payroll taxes. I mean, all those things do have to go into the mix. And so if you look at the Congressional Budget Office data for 2007, and you get similar numbers from the Urban Brookings Tax Policy Center or anybody else, you have the middle class paying, the middle quintile of the distribution, the people in the very middle, paying 14% of their income in taxes. You have people at the top paying 29%. So on average, it's clear that the burden is higher at the top. And yes, there are some people who are paying less at the individual level, but it's either because their income is being taxed at the corporate level, or it's because of things like municipal bonds that the Buffett rule wouldn't even touch.
But Alan, the Tax Policy Center recently estimated that even taking the corporate income tax into account and the payroll tax into account, more than 25% of millionaires are paying a lower effective tax rate than people making between $40,000 and $50,000 a year. There's something fundamentally wrong with the tax code that has seen progressivity undermined to that extent. We've seen progressivity fall markedly since the 1950s and 60s. But most recently, cutting the dividends rate from 39.6% to 15%, cutting the capital gains rate from 28% to 15%. In recent decades, the top driver of income inequality has been the distribution of capital income, the top of the income distribution, followed by changes in tax policy, overwhelmingly changing the way we tax capital income.
We're using these terms like right and wrong, David.
If I can interject, I mean, I think the problem is the assumption that we're making about that's being, I guess, projected onto the Buffett rule. The Buffett rule, I don't think, purports to be a cure-all. So you can't say, well, because the Buffett rule doesn't solve all those problems, it's worthless or it doesn't matter or we shouldn't do it. The Buffett rule, I think it's right to see it as a first step. Some might call it a symbolic step, others might call it a genuine step, but a first step towards more comprehensive tax reform.
But we're using terms like right and wrong. This is clearly right, this is wrong. But actually, when you look at proponents of supply-side economics, trickle-down economics and so forth, and we can get into those definitions in a moment, I'm sure we will. Is it wrong necessarily, though, for the richest to be taxed less, or are we counting on that lower taxation for them to put a disproportionate amount of effort and money and time into the economy? I mean, from a supply-side point of view, are we using the right sort of adjectives? Is it right that
well, I think tax policy always involves a judgment call. It involves balancing different things against each other. I think most of us agree that people who are well off should pay a higher percentage of their income in in taxes. I think that's a principle that nearly all Americans agree on and that I would subscribe to. I do think, though, that there is a trade-off, because as you increase the taxes at the top, especially taxes on investment income, you're undermining the incentives to save and invest. You're undermining the incentives to accumulate capital, which is what drives long-run growth for all Americans. So the trick is to strike the right. The trick is to strike the right balance.
When we look at this, how polarized the tax system is, and how little some are paying, and and where the burden, or the effective burden lies. I mean, what role does inequality play? Something actually that our patriotic millionaire said earlier struck me just now. Actually, he said, if you agree inequality is a bad thing, why have a tax system that exacables it? But does inequality play a part in capitalism?
But it doesn't exacerbate inequality. Again, we have the rich paying a higher percentage of their income than the middle class. The middle class paying more than the poor. We also have a set of transfer payments that go disproportionately to low and middle income people, as they should. So the government is definitely redistributing income, to make the distribution more equal. And some may say they should do more, and some may say they should do less. But I mean, we want to start from the premise that the government is doing that.
David,
it's combating inequality.
Aren't there these fundamental economic principles in play here, though? This idea of supply-side economics, that give the rich enough incentive to invest in the economy, then a rising tide will lift all boats and so forth. In which case, some of the current statistics aren't as horrendous as they seem, perhaps, to those of us who don't completely understand that point of view. I mean, and of course, hasn't President Obama himself, for all this talk about the Buffett Rule and the Democratic Party, largely accepted that supply-side economic principle, frankly, that deregulation and over too much taxes actually are a hindrance rather to business?
Well, I certainly think the Democratic Party has been complicit in a lot of these tax policies, a lot of these deregulatory policies that are premised on the idea that the more money rich people have, the more it will trickle down. I take the alternate view. I think that what we have is a tax system that incentivizes investment income over wage income, that a tax system that encourages capital gains income instead of rewarding or better rewarding income made by wages. Most Americans make their money by wages. Certainly there's a mix in people's portfolios, but we have a tax system that basically says what you earn in wages is taxed at a higher rate for the most part than what you earn in investment. And the question is, do we want to have that tax system? We didn't have a tax system like that, or not nearly as much like that, back in the eras when our economy was growing a lot faster, especially for the middle class. And I think we need to look at that history, ask, why did the middle class grow so fast? Why did middle class wages grow so fast under basically a different tax system than we have today?
Piggybacking onto that point, the tax on wages and salaries is a tax on human capital. You've got a return on physical capital that's affected by the capital gains rate. You've got a return on human capital. Why should we preference private capital, physical capital over human capital?
I think that's a bit of a misleading comparison, because a human capital formation through things like education and so on also receives extensive government subsidies, and rightly so. We have federal programs and we have state and local programs that are designed to promote education, and that's really an important part of what government does in our society and should continue to do. But again, I think we keep having this discussion that assumes that the government is sitting out there doing absolutely nothing to promote income equality, that it's doing nothing to promote human capital, and we need to take into account what the government is doing already and ask ourselves, do we need to do more? Do we need to do something different? Do we need to do less in some areas?
Well, actually, let's look at the example. The Ryan budget, the Paul Ryan budget, which you mentioned, it cuts the top tax rate then from 35 to 25%. So that's some have estimated that's like $150,000 extra for the top wage earners. Meanwhile, those social programs, education programs and so forth will be slashed. What is the principle at play there? How will that lead to growth if if the majority of people are earning less? Who's buying the goods and services? I mean, how does it all work? What's the fundamental principle at play there?
Well, first, I don't want to get sort of too technical of economics. I mean, long-run growth doesn't depend upon demand, so this question of who's going to buy them is really not the issue. I mean, as incomes rise throughout the economy, from things being produced, that gives people the income to buy the things that are produced. So the question is, how do we promote the capital, the infrastructure, the human capital, the physical capital that will drive growth forward? And part of the solution to that is, in fact, to have a friendly tax environment for investment. Part of it is also having adequate infrastructure. Part of it is also having fiscal balance.
But is there some cognitive dissonance then saying, look, the deficit is our main priority, but we can't raise taxes and increase revenue from the rich? I mean, how can those both stand at the same time?
Well, I think we will need to increase revenues eventually. I mean, I think if you look at the size of the fiscal imbalance, there's just no question that what we'll ultimately have to have is a bipartisan solution that will involve both entitlement cuts and tax increases. And we'll have to come to
entitlement cuts meaning cutting people's
Social Security and
pensions
Medicare primarily. Social Security and Medicare primarily. Right. Yeah, I mean, I don't think that cutting anti-poverty programs is really the way to go. It's the middle class transfer programs like Social Security and Medicare that will.
Does it make sense to you, Andrew?
Transferring back to the Ryan budget, you're talking about $5.3 trillion in domestic spending cuts that wouldn't pay for Ryan's tax cuts. That pays for a continuation of the Bush-era tax cuts and indexing the alternative minimum tax.
Let's
that 25% cut is
already, sadly, we're running out of time. Can we look at, technically, I mean, I'm sure you've looked at the numbers. Is there a correlation between reducing the top income tax rate and growth? Is there a correlation between or increasing the top taxation rate and economic and income mobility? I mean, can you trace a connection between these things, you think?
Christina Romer and David Romer out at UC Berkeley have looked at the impact of top marginal tax rates, find very little correlation to growth. Len Berman, tax expert up at Syracuse University, has found absolutely no correlation, lagged over a number of years, between the rate on capital gains realizations and economic performance. I think the case is even further undermined by our experience with the Bush-era economic expansion. Bush-era tax cuts were the predominant economic policy, presiding over what is unequivocally the worst economic expansion since World War II. Worst GDP growth, non-residential housing growth, employment growth. Terrible.
And that's always the point. Theoretically, we should be in a boom right now.
Well, no, but because many different factors affect the economy. Look, right. I mean, I think if someone were to sit up here and say the only thing that affects the economy is taxes, therefore, anytime you cut tax rates, you will always have a strong economy, no matter what else is going on, it would be easy to prove that that's a ridiculous statement. And the experience we've had in the last decade would be one of many thousands of ways that you could disprove that statement. But I mean, certainly that's not a statement I make. I don't think it's a statement any responsible person is making. We have good microeconomic evidence that people respond to tax incentives. We have evidence from a number of statistical studies done by economists across the ideological spectrum that people report higher taxable income when their marginal tax rates are lower. We have evidence from the timing of consumption that people do that saving is responsive to the after-tax interest rate. So I think there's evidence here that incentives matter, something that I think also just cries out to us from every aspect
incentives
of human
both
life.
For the rich because they know that they get to keep their money, and incentives for the poor because they're in such bad shape?
Well, no, everyone is affected by incentives. I think ideally you want low marginal tax rates for everyone. You would have to balance that against other considerations. I think tax rates on saving and investment are particularly pernicious because capital accumulation is what drives one of the main drivers of long-run growth, and because today we actually have relatively high tax rates on investment income when you consider the individual income tax, the corporate income tax, the estate and gift tax.
But you also have to look at the way you're financing it.
If I can make a point here, I mean, like, you can't ignore the history. You can't ignore the history. I mean, you're right that taxes aren't the only driver in an economy, but taxes do play a role. I mean, you look at the Clinton boom. The Clinton era boom happened after we raised marginal tax rates. We had a bigger boom back in the 50s and the 1960s when we had higher marginal tax rates. I agree that those weren't the only drivers of that boom, but it's worth asking the question, how did those booms happen when tax rates were higher? I would argue that part of the reason they happened is when you have higher marginal tax rates, you are effectively encouraging money to be put back into the business rather than being taken out of the business. No, that when you say you can write off an expense that you put into the business and not face higher marginal tax rates, that's a form of incentive to keep money in a business rather than taking it out.
Actually, I'm sorry, that's squarely incorrect because the proceeds of the investment are being taxed as well. I mean, if you can write the investment off immediately, then the higher tax rate is a wash. It doesn't affect it either way. If you have to depreciate it, which is our normal tax rule, the higher tax rate penalizes the investment.
David Sirota, how did that position
if
that you just espoused?
If I'm a business owner and I have a choice of facing a higher tax rate when I take my money out of the business as profit or taking that money in profit and putting it back into the business, and the higher marginal tax rate, it penalizes me for that decision. A lower marginal tax rate effectively encourages me to take that money out of the business.
Because the proceeds of the investment are going to be taxed.
That's absolutely true.
All right, no, that's not. One thing, though, I mean, as far as the ideological framework here is concerned, how did this idea that the sort of things that you, David Sirota and Andrew Fieldhouse are espousing, how did the notion come about there that is akin to class warfare there? I mean, what happened since Reagan and now then? How did this occur? Was it simply that we looked at the statistics and realized the other way was right?
Well, I think it's a fair question. How far has the Republican Party, for instance, shifted since Ronald Reagan was making this argument? Ronald Reagan making the same argument today would be portrayed as some sort of socialist communist. If Barack Obama got up and literally read the same words as Ronald Reagan, you would hear conservatives call him some kind of menace to America, some kind of leftist menace to America.
That's not true.
How has that changed? I mean, it's a very, very good question. It's a very fair question.
There's no similarity between what President Obama is doing and what President Reagan did. I mean, President Reagan's tax reform led to a top tax rate of 28%. And President Reagan said, yes, let's get rid of the tax preferences and let's lower tax rates. So, I mean, I don't understand how that remotely maps into anything that the Buffett
President Reagan made the comment.
Here.
President Reagan made the comment that millionaires should not pay a lower effective tax rate than the
Which
rest
was our
of
starting
us.
point. Yeah.
Saying exactly what President Reagan said is exactly what President Obama has said, and got President
today
Obama
is already,
labeled as a socialist.
Is already honoring that principle. Again,
Andrew Fieldhouse, last word. We've only got 20 seconds.
The difference is President Reagan knew that you had to raise revenue and you had to have balanced deficit reduction. Without raising revenue, the burden of deficit reduction necessarily falls on poor and working Americans. That is fundamentally unacceptable. You need revenue from the top to balance that out. It's that simple.
All right, then Andrew Fieldhouse, Alan Viard, thank you very much. David Sirota, thank you as well. That's all from the team in Washington, D.C. Don't forget to follow us on Twitter and Facebook, where you can find more information about the program. And we want to hear from you. Tell us what stories you think we should be covering. Send your ideas directly to us at InsideStory@aljazeera.net.